Hey guys, hope you're doing well. Told you I was going to be back with another video today. I'm going down the rabbit hole of stable coins, which if you look at, kind of peel back the layers of the onion and look behind the veil, you see that for the most part, what I'm seeing, these stable coins, especially Tether, are the opposite of stable. They're the least stable thing I have ever seen in my life. They might be tracking the price of the dollar so far, but my goodness gracious, are they anything but stable? Or they are far from stable, I should say. Okay, so let's dive into the content. Yeah, unstable coins, that's for sure. Man, I'm so glad that Macintosh kind of sent me a couple texts this morning, or I never would have. I kind of understood stable coins and the concepts, very similar, like an ETF or something like that. But boy, I didn't realize what was going on. So, and before I go any further, I want to do a huge shout out to my good buddy, Meet Kevin, right here. Not a very good picture of him there. I got him on pause. Sorry, Kevin. But as I was going through this, and he came out with a video that is talking about this exact same thing. I didn't talk to him about this today. It's just very coincidental that he came out with this video like an hour ago or so, maybe a couple hours ago, and I've been going through this all day. So, but I want to do a big shout out to him because he's got a great video on this, and I referenced I'm going to reference this article he was using from Bloomberg. So thanks, Kevin. I appreciate it, my friend. So let's go over to this Bloomberg article. First, like we said in the last video, a stablecoin such as Tether the premise is really you give them your dollars and they give you Tether in return, and there's a one-to-one backing for the underlying asset or the assets held that are dollar denominated and the amount of tethers that are in existence according to Tether. Now, that's debatable, like we went over in the last video, but let's just assume for a moment what they're saying is true and it's all above board, and they are taking those dollars and they're buying dollar denominated assets. Now, I think most people are under the impression that if there's 300 billion tethers in existence, as an example, they just have 300 billion in cash just sitting at a bank somewhere. That is not what they're doing. And so let's dive into this Bloomberg article that goes over the dollar denominated assets that are on their balance sheet. Then they're admitting to this, that back up all of those tethers that most people are trading back and forth, assuming there's a one-to-one ratio there. So actually, you know what? I'm going to go over to this other article because I think it summarizes it a little bit better. So this is from Coindesk, and Tether's first reserve breakdown shows token 49%, basically 50% backed by unspecified commercial paper. So corporate bonds, in essence, or short-term paper. Okay, so I get it that there's going to be a lot of price fluctuation, and Tether would probably come back and saying, well, that doesn't really affect us because we're holding to maturity. Okay, well, what's the underlying risk of the commercial paper? I mean, who are you lending to? Are you lending to Apple or Google or Ford, or are you lending to Radio Shack? Are you lending to GameStop? I mean, there's a little difference there, and they're not specifying the quality of corporate paper. And I mean, you've got massive counterparty risk there. Just because it's commercial paper and it's short term and you're saying you're holding to maturity, so what? It again, if you're lending that money to a very risky corporation, who knows what their balance sheet looks like, you've got that counterparty risk that they might not pay you at the end of the 6 months or the end of the year, the end of the 2 years, or whatever the maturity is on the commercial paper itself. And so 50%, I mean, let's go take it to an extreme and just assume, obviously it's most likely wouldn't happen, but just so we understand the concept here, let's take it to an extreme and say that let's say there are 100 billion in tethers, and they have 100 billion in USD denominated assets to back up those 100 billion, excuse me, tether. But then 49%, 50%, they have to take a drawdown, a write down with 50% of the assets. What does that do to the value of the tethers you hold? And that's a rhetorical question, but for those of you who aren't following, the value goes down a hell of a lot lower than $1. I can tell you that for sure. And then it gets even worse from a standpoint of, okay, well, what's the other 50% that they're admitting to? It's not like this is some sort of, conspiracy, like that other article is kind of saying that, this is what's happening with Tether and it's a big scam and that could bring down the whole cryptocurrency market. But that's kind of, okay, you're having to put the pieces of the puzzle together and connect dots that may or may not be there. This is straight from Tether, as far as saying that here's what we're investing in. This is what our balance sheet looks like. These are the dollar denominated assets that back up the actual tokens. Here you go. So here's a pie chart. You got commercial paper at 65%. Oh, I see. So of the cash and cash equivalents, then they've got, so that's 75%, 76%. They've got a further breakdown. Let's see if I can expand that. There you go. That's easier to see. So of the cash and cash equivalents, they break it down into a more specific pie chart that includes 65% commercial paper, fiduciary deposits, 24% cash, which people think is probably 100%. But look at this. Reserve repo notes. What? You're going into the repo market? So if I'm understanding this correctly, Tether is providing liquidity for the repo market. They could be doing business with the Fed. They could be taking their dollars, giving them to the Fed in a reverse repo where they're getting more treasuries. I don't know why they would do that, or most likely they're not doing that with the Fed. They're probably doing that with other banks. So they're giving the banks or hedge funds probably cash. The hedge funds are giving them treasuries, which, oh, by the way, most likely have been rehypothecated. If you guys remember the whiteboard video I did, the last one, remember when I was talking about the treasury that is being taken as collateral by the bank and then sold into the treasury market and ends up on the balance sheet of a financial institution, never leaves the balance sheet of the Fed. So that one treasury is an asset of the Fed, and simultaneously an asset of XYZ financial institution that just purchased the treasury from the treasury market. And that financial institution could be Tether. So who owns the treasury? Does Tether or does the Fed? I don't know. And let's take that to an extreme. Let's say we're not using the Fed as a counterparty here, and we're using 10 other banks. Why? Because that treasury has been rehypothecated 10 times in this example. And now it's on the balance sheet of Tether, but who the hell owns the treasury? Who knows? It isn't going to be Tether at the end of the day, because they're buying a treasury that has been rehypothecated. Therefore, by definition, someone else is the original owner. So that's stable for a stable coin. I mean, wow. Okay. And then, we go back to the commercial paper that we talked about. Oh, and then look at this, 1.64% other investments, including other cryptocurrencies. What? Okay. At least it got some precious metals in there, but still, I mean, precious metals can go down in price. I mean, think about that. With the commercial paper, at least if it works out, you don't have any risk to the nominal value of the asset itself, right? If you buy $1,000 worth of commercial paper and you hold it to maturity, unless they go bust, you're going to get the $1,000 back, regardless of what happens with the price of the bond in the interim, or regardless of what happens in the interest rate in the interim. But with gold, I mean, okay, how does that work? What happens if gold goes down by 10% and people are demanding liquidity? I mean, what happens to the overall portfolio here, or the overall balance sheet, are we doing mark-to-market accounting? I would assume not, but that leads me to something. Let's go back to the Bloomberg article, because that's a good question. So how are they using the accounting to determine the value of the assets that are supposed to back up the Tether's 1-for-1, right? I mean, that could fluctuate daily. So I'm not sure where it is in this article, but the bottom line is they quote something from the website of Tether, saying that they basically use the value of the asset when it was purchased. I think this might be it. Oh, that's not it. That might be. Well, I'm not sure where it is in this article. I would highly suggest reading this if you guys are interested in cryptocurrency. But the bottom line is they give it a value based on what they paid for it. And that's the balance sheet. That's the asset, or the underlying value of the assets that are backing up the tethers. It's not, okay. So if they bought gold, let's take it to an extreme again. So say they bought gold at $2,000 an ounce, and gold goes down to 1,000. Well, that's going to affect the value if people want to redeem, but yet on their balance sheet, or the assets would still match up with the liabilities, basically, even though the value of those assets have gone down by 50%. That's how they're doing the accounting to get to this point. And then the author goes on to say that the type of accounting they use there's no way you could do that. That would never be allowed with, like an ETF or something that was kind of structurally similar, or a money market fund. I think is maybe even more similar. That there's no way that accounting would fly with like an actual money market account. Excuse me, a money market fund that was regulated by the SEC. And for obvious reasons. I mean, this is craziness. Let's just assume for a moment that Tether is above board and they're not issuing more tethers than what they're saying. Okay, but even based on what they're saying, this is insane. This is crazy. Even based on just what they're disclosing, the company itself. I mean, you know what it goes back to? You have to ask yourself, so why would someone use Tether? Well, because in order to use dollars, according to what I've read, the crypto exchanges, every time you go back and forth, may charge you a spread. They may charge you like 2%, right? Where Tether charges you like 1 basis point or something like that. It's almost free. So whenever you have something like that, you're like, oh my gosh, I'm using Tether. People just assume that, oh, Tether's just, the technology is more sophisticated. That's why they don't have to charge the 2%. Or they're just not greedy like those banksters. That's why they're charging less than 2%. No. That's not the way it works in the real world. In the real world, if you're getting something at that much of a discount, the reason is because you are taking a lot more risk. Or another way to look at it is if you're investing in like a money market account or money market fund, let's say, at your bank, and they're offering you a much higher interest rate than you would get in a savings account, there's a reason why. And the reason is because they're taking far more risk than you would most likely be comfortable with if you did the underlying analysis and peeled back the layers of the onion. There's no free lunch at the end of the day. There's no free lunch. So people are thinking that they're buying this Tether and using Tether to trade back and forth and to go out of positions and into other positions. And it's just the most amazing thing because it's almost free. And they don't understand the actual price they're paying. And that's in the form of risk. So I wanted to go over that. Let's see how many people we've got on the live stream. Yeah, I'm just reading some of the comments in the live stream. I think I won't go on and on and on about this because I don't want to kind of beat a dead horse. I think you guys get it now, and I'll probably do a whiteboard video on it tomorrow. So let's go ahead and do some shout outs, and then I'm going to go for a jog and get some dinner here. But I wanted to go a little deeper than I went on that previous video because this is just shocking. I mean, it really is. I don't think I'm being hyperbolic by saying that this is just really crazy stuff that we're talking about once you dig underneath the surface and find out actually what is happening with these quote unquote stable coins, especially with Tether. Wow. All right, guys, let's do some show. Oh, Anthony's in the house. Cool. Taxicus 1979. Thank you for hanging out with me, my friend. From Camo, Jake Spice, the angriest puppy, none of your beeswax, Michael Rohrbaugh, Scott M. Sewell, Daniel Tukanduva, Justin Cabral, Ty Gorton, Angelique in the house, Pork Barrel Investing, Wayne Smith, Sustainable Lumber Company, Douglas Boucher, I'm going to guess. L. Dan, Steve Z, Ross Gray, Dominic Stape in the house, Charles Robb, me, Alan Zibelman, Annette Walls, Ganame, Christina M. Oh, here's one. Cabragoon Cabulus. Value stonks. All right, guys. Enjoy the rest of your evening. We'll see you on the next video.